Hello everyone, welcome to ACCA Webinar FM. This is your instructor RIZWAN MANIYA. It's day 2 and let's make day 2 more interactive and let's ensure that this becomes another great session for you people and help you to ace in your FM paper. So quickly, the first thing, those who are new today, to remain connected with me, you need to send me a quick WhatsApp message at this number and I will share the group link as I did yesterday. Those who send me the message, they are now part of the group. This group is important till the exam day. Whatever support I'm going to give you people, this group will play a very important role in that. Okay. Secondly, to stay connected during the webinar, you have to follow the chat box. There is a chat box given through which you will be answering me whatever I'll ask you. Okay. Day-wise plan. The first day was about investment appraisal and WACC, obviously, but yesterday we could not finish WACC. We could not start WACC. So today we will first start with WACC and we'll move towards business valuation and then we will be covering business finance and the remaining area. So you have a good day, 3 days plan in front of you. Remember about the mock package I told you yesterday. Those who are interested in mock, please, they will contact us on the WhatsApp group. We'll share the details. This mock package will definitely be useful for you, will give you the confidence. And this is a complete good package which also includes important topic videos, but yeah, it's unfortunately the paid one, so we'll share the details of this on the respective WhatsApp group pretty much soon. But you also can attend my grand revision of this paper. That is free for all. Everybody can join this. We will share the dates and timings for this as well on the WhatsApp group. So if you are not part of the group yet, please send me a quick message on this number. Now, we were doing a question yesterday and that was relating to NPV. So I will quickly jump to the question again and will quickly finish the calculative part that we already did yesterday half and the remaining part still left. So let's move towards this question and let's see what are we supposed to do. The question was relating to NPV obviously, and you can see the things are still in front of you. So let's begin with the same information that you have here right now. Now as you just saw that we were required to work out the NPV of the first project, and we did work out the NPV of the first project. Let me just clear all this information. Okay, so let's begin with this question. We did solve part A in the yesterday's webinar, and right now we're focusing on the second part of this question, and it's important. I just want to tell you very important thing here. So we will definitely be starting with the second part of the same question, and for that obviously we have done the workings yesterday relating to the first part. That was of 8 marks. I told you the marking scheme. Now here I want to start with this second part where you need to work out the NPV using real method. So, as per the question, you can see here, we are provided with the information about 2 types of cost of capital. This is the real cost of capital of 8%, and we are also given with the generator inflation of 3.7% per year for the foreseeable future. Now, the best approach, the only valid approach in this scenario is to do what? Now, according to examiner reports, many students did different types of mistake. Okay, the first I just need to tell you what will be the right approach. So what I'm doing here, I'm starting this part B, in fact A2, and year 0, 1, 2, 3 and 4. Now From my part A, okay, from my part A, one figure I will use, as I've done the part A working yesterday, so I'm just rewriting this again, and I'm using one figure of part A, and that figure is taxable cash flow figure. Okay, taxable cash flow figure is a one from which I will be starting. Now this figure is basically coming from part A, and obviously we know that that figure is nominal one, which is an inflated one. I'm just telling you the figures. I know the figures. If you don't have, doesn't matter. Just listen to me carefully. So it's 14148. Okay, this is for year 1. The figure was 14148. This is basically the inflated figure. Second, 24097 was the second year figure. The third year figure was 39948, and the fourth year figure is 10379. So this is the figure of taxable cash flow that is coming from part A, and you know that all these figures are inflated ones. Okay, this is all inflated ones. We have converted the cash flows into inflated cash flows. Okay, so what we were supposed to do, as we have done first part, we also have an NPV of this first part. So I'll just write here NPV approximately in thousands was 33347, and this was in thousands. So this was your inflated nominal NPV from coming from the first part, right? So as I'm saying here, that what exactly we're going to do when we are solving part 2, where we are supposed to work out the NPV using real method. So what exactly do we need to do? So try to figure out what I'm saying here. Now what we'll do is that we'll use the same years here, okay? And the best approach is that we will use the inflated taxable cash flows that we have worked out in part A, and we'll deflate those cash flows to make this real. Okay, so because this taxable cash flow includes three things. Number one, it includes sales revenue, it includes variable cost, it includes fixed cost. So once you've deducted all these, so you arrive at taxable cash flow. So you can see these taxable cash flow figures, and we'll deflate these figures to come to the real cash flows. Okay, so let's do this. Let's work out real taxable cash flows. Okay, now how to do this? It's very simple. I have generator of inflation given here. This generator of inflation was something that you have to use in the paper, and examiner has mentioned in the examiner report. Anyone who is not using this 3.7% is actually losing the marks. It's not the right approach if you're not using this. So you have to make sure that you use this figure that is given to you here in the question. And how will we do this? We will use this generator of inflation, and using this we'll deflate the taxable cash flows to make this real one. So what to do here? It's simple. It's very simple how to deflate it. Now you know how we used to inflate it. Okay, for inflation we used to multiply the cash flows with the inflation rate. So to deflate it, we'll divide the cash flow with the rate of inflation. Okay, so let me give you a quick idea what you used to do when we used to incorporate the inflation. So we used to use the real cash flows, okay, like this, and we used to multiply this with 1 plus inflation, okay, and we used to use the power as well, and like this we were calculating the nominal cash flows. Okay, so now what you need to do, you need to deflate it. We have the nominal figures, we have this as well. So this means I need to divide this to work out the real cash flows if I need to work out this missing figure. So what will I do is, it's simple. Real cash flows is equals to nominal cash flows divided by 1 plus I to the power n. Okay. So like this, I will deflate this and will work out the real cash flows, because now I need to find out this missing figure. So I have the nominated cash flows here, okay, and I have the rate of inflation, general one. So I'll just deflate this and will make this real cash flow. So this is the formula, as you just can see in front of your screen. This is the formula that I'll be using right now. Okay, so let's do it. It's very simple. Please listen what I'm doing here. It's simple. I'm again using one formula, will copy paste the figures and I will achieve my results. So I'm connecting this. This is my nominal cash flow. I'll divide this. We'll open the bracket 1.037. Now I'm using the general rate of inflation. Okay, 1.037. I just showed you that here it is 1.037, it's 3.7%, right? So 1.037 and I'll attach again power. So for year 1, obviously we need to deflate it by using power 1. For year 2, we'll deflate this by using power 2. For year 3, we'll deflate this by using power 3. And for year 4, we'll deflate this by using power 4. So here you have the figures. This is 13643, okay, and now I'll just copy and paste here with Control C and Control V. So once I do Control V, I get the figures. Now a quick check if you want to. So let's check this if you quickly want to check. So it's easy to check here. Let me open the cell for you people. See, 10,379 was the figure, and what I did was I just deflated this figure and I've used power 4 obviously. So this is how you need to convert these into real cash flows. As you can see in front of yourself, these all are converted into real cash flows now. Okay, so this is what is the best approach for such type of a question where you are given with the general rate of inflation separately. So like this, you need to deflate it. Okay, you need to deflate it and you can bring this to the real cost or real cash flows. Okay, done. I hope this is clear to all of you, right? So by using the formula I just mentioned here, this one I'm talking about, you can see this formula I'm talking about. So I have just deflated the cash flows. Now let's apply tax. Same here. Don't forget minus sign. This figure multiplied by 0.26. Same here. Control C, Control V, and you are getting the negative figures here. Obviously, these are your negative figures which you will obviously deduct. So this is the tax amount that you have already seen here in front of yourself. Now moving towards the next thing was tax savings. Obviously tax savings figure. Now the same tax saving figures that you have used in your first part yesterday will be used here. The same tax saving figures will be used here. So try to ensure what I'm saying. The same tax figures will be used here because when it comes to capital allowances tax savings, so in that case we don't inflate those, and for both the methods, whether it's nominal or whether it's real method NPV, in both the cases we take capital allowance tax saving, same figure in both the cases. So I know the figures, you have already done the working, so I'm just writing the figures here. It's 1300 positive cash flow for year 1, it's 975 for year 2, it's 731 for year 3, and it's 2194 for year 4. So these are the figures of tax savings you have for 4 years. So once again I'm repeating here that remember, when it comes to real method or it comes to nominal method, you don't take any inflation impact in that, and the figure of tax saving of capital allowance remains same whether it's a real method or a nominal method. Okay, so done with this. Now investment. So let's look at the investment. Investment was of 20 million. So as I'm doing workings in thousands right now, it's 20,000, and here comes net cash flows. Okay, so let's use the sum formula. I'm selecting these figures as you can see in front of your screen. Control C, Control V, and these are your net cash flows in front of yourself. I hope this is clear to all of you. The before tax figures are in front of you. I've done the calculation of all these. Now it's time to discount these using cost of capital. Obviously, real is what I will be taking here. Now, what is the real cost of capital? It's 8% given in the question. So, let's use this 8% given in the question. Okay, 8% is what we're going to use here, because if cash flows are in real terms, so the cost of capital should also be in real terms. So, let's apply the formula. Let's open the cell by is equals to 1 divided by, open the bracket, 1.08 is the discount cost of capital, power. I'll connect this with the year. So it's 1. Let's copy this with Control C and let's paste all these with Control V, and you have the discount factors here. It's time to work out the present values now. So let's work out the present value. We'll multiply the discount factors with the net cash flows. Control C and select all, Control V. So you can see the present value. Let's work out the NPV as well. And for that, it's simple, is equals to, we'll use the sum function, we'll open the bracket, we'll select all these one by one, and we'll press button enter, and this will give us the answer of real method NPV. So I hope real method NPV is clear to all of you, and the way I've done the calculation is obviously clear to all of you how I was required to work out these things. So done with this one, obviously no issues. Now let's look at the marking scheme. This was for 4 marks. So 1 mark obviously you will get for this deflation thing that you did, 1 mark, okay, and then 1 mark you are getting for the tax payments that you have worked out, okay, and then 1 mark you are getting for the final NPVs that you have worked out, the present values, okay, and the remaining 1 mark that is left here, you will get that 1 mark through the comment that you were required to do. So we will comment here as well. So we look at the comment because the question has stated that you have to comment on your findings, okay, comment on your findings. So let's look at the comment on the findings. Now, so you can see here, I told you a function yesterday. It was very useful function. I'll just select these cash flows, and you can see this option here. We'll select the 10th option, and everything, you know, will be rounded off. Brackets will also come here. So that's nice. And we'll select this. This is the option. Go to customs, go to numbers. Normally we represent discount rates 3 decimal places. So this is what I am doing here, and you can see the workings have been done. So the NPV that you are getting using both the methods, let me just highlight this. Yeah, it's 33347 and it's 33722. So you are seeing here that the answers are very much similar as far as both are concerned. So what comment will we be writing here? What comment exactly we need to write here? So the first thing is the NPV is similar. We should know the concept that NPV that we work out using nominal and real method is same. It should be same. But there is a reason when it is not same. As you can see here, there is a small difference between 33347 and 33722. So what is the reason behind this? The NPV should be same using the two methods. Okay. Reason for difference here is tax savings. Okay. Now, as I told you that tax savings is something we don't actually inflate those, and the tax saving figure that I took here is exactly the same in both the methods. The other things were adjusted for the inflation effect, but not the tax saving on capital allowances. So that's why the result is different, because tax savings are discounted using different rates. So you know that in nominal we use the rate of it was, I think, 12%, if I'm not wrong. Yeah, 12%, and here we use rates of 8%. So this is the difference. That's why you are getting a small difference. So reason for the difference is that tax saving were discounted using different rates, using nominal and real method. Anyways, the project is acceptable. Okay, acceptable as the NPV is positive. So I hope this is clear. NPV is positive. The project is acceptable in both the cases, but technically it should be same. If it is not, so the reason here is tax saving. Mainly the reason is tax saving. So tax saving is the reason because of which you can see the difference in NPV, a small difference, but yeah, it is the reason for the difference in NPV, because tax saving figures used in both the methods are same, and you discount those using different rates. In nominal we used 12% and in real we used 8%. So this is the basic difference here. Okay, so this is what was required to be done in this part, and you were given with the general rate of inflation. You should use that to deflate the nominal cash flows and convert those nominal cash flows into real cash flows. This was required in the question, and this is what I did, and you will get 1 mark here for the comment as well. So I hope this is clear to all of you, the working that I've done in front of you, and this is obviously time saving because I used the taxable inflated figures. I just deflated this using the generative inflation, then it was normal tax saving figure was same. The rest all was the normal calculation that we always used to do, and this is what we have done, and this is the comment part. Obviously don't write comment in bullets as I've done here. This was just to show you the bullets, but in paper obviously you will write in a paragraph form. Okay, so this will be written in form of a paragraph. Write all these 3 points in one paragraph. So I hope this is clear to all of you. Now, okay, so now any questions, anyone? Is this clear to all of you? Yes, any questions, anyone? Are you all with me? Say yes or no. The first requirement was of nominal, so that's why we had to start with nominal first. Okay? Done, right? No questions, anyone? Yeah, if any of the rate is missing, maybe real or nominal, so we'll use Fisher effect and we'll convert that nominal into real or real into nominal. Exactly. Understood, right? Okay. I mentioned here the difference of the two NPVs in this case was because of tax savings on capital allowances, because we do not incorporate inflation into tax savings. That's why we use the same figures for both the methods, and it's a common sense thing. If one figure that is being used in both the methods, so if one figure is discounted at 12% and if one figure is discounted at 8%, so obviously because of the different discount rates, there will be a difference in the values, and that basically becomes the reason in the difference in the NPVs. Okay? So, okay. So, I'll just quickly show you. Okay, see how I did. You can see these are the things, and now you can just use this option here, format as number. Just click it, go to custom, and then just select this number and just use the decimal policy whatever you want to. So this is how I have used 3 decimal place policy here. Okay. Karthik, real terms meaning we cannot use current price. Now in this case you cannot, because you were given with the generator of inflation, so the best approach was to convert the nominal into real. Okay. So this was the best approach that you had to follow, because you were given generator of inflation separately in this question. So that is why it was better to just convert that or deflate that using that rate and make that the real one. Okay. So this was the best thing you need to do. Okay, so we are done with this one. Now it's time to move on towards the next thing that we are exactly required to do, and what is as far as theory is concerned. So quickly I need to jump towards one of the important things that I always tell students regarding the theory is to break the question into verbs and objects. Now this is normally I tell them for theory based questions that are tested in section C. So I'll quickly jump towards that as well. Now if you look here, the question, the same question I'm talking about, if you see here, the last part is of 8 marks, and discuss 4 ways to encourage managers to achieve stakeholder objectives. Okay. Now in this case, part B, if you look here, so every theory question of section C requires you to determine 2 things, especially in theory. Okay. The verb. Now what is a verb? It's discuss, illustrate, briefly discuss, justify, evaluate, compare, prepare. These are all verbs, examinable verbs. Okay. And the verbs, whenever you read a verb, obviously that verb is used for some kind of an object. Okay. So it's very important to determine the object, or I can say the element. I can even say element here. So it's very important to figure out the object or the element for which the verb is being used. So if someone says discuss, okay, so you know discuss, fine. But what to discuss? What to discuss? For which you need to do a discussion. So that is the object for which the verb is being used, right? So every theory question, if you deal, just break this into verbs and objects. So quickly, I'll not take too much time on this part. So it says discuss 4 ways to encourage managers to achieve stakeholder objectives. Now, the examinable verb is no doubt it's discuss, right? It's discuss. It's simple. Examinable verb is discuss. Now, what to discuss? Okay. So, it says 4 ways to encourage managers to achieve the stakeholder objectives. So, the object or element is 4 ways to achieve stakeholder objective. 4 ways through which managers can achieve the stakeholders objective. Now, this is the object. So, now your answer should focus on these 4 ways, 4 methods through which you think manager will achieve the stakeholder objectives. Now, this is for 8 marks. So, how you will deal with theory like this in the paper? It's for 8 marks and it says clearly 4 ways. So, I can easily break in my mind that 8 divided by 4, which means I need to write 2 marks for 2 marks. Okay, I need to write 2 marks for each point, right? So, 2 marks are allocated for each point here. So, if there are 4 ways, so 1, 2 marks, second 2 mark, third 2 mark and 4 2 marks. So, it's an easy split that you can understand here. 8 divided by 4, 2 marks, right? So, make sure whatever options you write, you have to write those in separate paragraphs. So, you have to use separate paras for all those. Okay. Now, 4 paragraphs, 4 methods. As you need to discuss, so you need to cover up the angles properly, okay, about the options. So, quickly, one that I can tell you is share option scheme, okay. So, this option, what do you think? Is this option good for managers to ensure that they achieve the stakeholders' objectives? Yes, share option scheme is a good method. You will write that through this method, managers will be encouraged to consider the stakeholders' objectives, because in share option scheme, obviously, we will give them shares, okay, that they can get later on. They become the owners and they will try to improve the share price, okay, because after getting the bonus, they will try to improve the share price, and this share price increase obviously will benefit the managers themselves, plus it will benefit obviously the stakeholders of an organization as well. So, one option through which you can align their interest is share option scheme, and this is what you have to write in a paragraph for 2 marks, okay. The other option is performance related pays, okay. This is also a good option, performance related pays. Now, what do you mean by this performance related pays? You can set certain targets for them to achieve, and you can pay them if they achieve the targets. For example, target for earning per share, okay. So, if there is a target for earning per share, they achieve the target, they get the reward for that in form of their bonus, and that will also encourage them to achieve the targets, and those targets are really important that should achieve the stakeholders objective. So, the determination, the identification of the target, right targets should be made, okay, to ensure that stakeholder objectives are achieved. So, performance related pay is second option, which you will again write in a paragraph form, and this is for 2 marks. Then the next what we have is another option that is coming in my mind is to ensure that they achieve the best thing. So, I can write about the stock exchange listing regulations, okay. So, stock exchange listing regulations also will ensure the shareholders are, the managers are working in line with the stakeholders' objectives, because according to these regulations, the disclosure of the important information is important. Okay, you need to disclose important information so that everybody gets to know what exactly directors or managers are doing. So stock exchange listing is another method through which you can ensure that managers are working in the best interest of the stakeholders' objective by disclosing all relevant information that is required as per the regulation. Another is the audit. Okay, audit of financial statements. This is another way through which we can ensure that they are working in the best interest of the stakeholders' objective. This will also give a surety, certainty to a very higher extent that things are going in the right way. So these are the four ways through which we can ensure that managers achieve stakeholders' objective, and all these will be written in separate paragraphs. You can use subheadings if you want to, okay, but separate paragraphs are important, and you know the weightage of these. So it was of 8 marks, 4 ways, 8 divided by 4. It's a simple division, 2 marks for each paragraph. It's simple. So I hope this is clear, because section C requires us to follow certain things when you are writing the answer. So it says that simple English is what you have to focus on rather than long rambling sentences. Simple English which have no structure or no real content. So this is what I tried to achieve here. I told you the format of the narrative questions. For numerical ones, I also showed you the answer on the spreadsheet, how to present the things with proper connection, with proper workings, with proper references. So I hope this complete question will give you a really good idea how to draft the answer for theory and how to perform calculation on a spreadsheet. So this was all about investment appraisal area that we did covered right now. Now friends, it's time to move towards the second important area of our exam, and that is cost of capital. Normally we call this as weighted average cost of capital, known as WACC. So for WACC, what exactly we will be doing? So I'll give you a quick first idea about certain things that are part of WACC. Okay, obviously my focus will not be on explaining the knowledge. It will be more focusing towards the calculations, as you know. So I'll give you a quick skim about the key areas first of all, and then I'll move towards the question. And once I move towards the question, now by looking at the requirements, okay, whatever is being asked, so I'll come back to the theory, come back to the basic textbook knowledge, and in relation to that, I'll give you the recap in a detailed way and we'll solve that. Okay, so the strategy is very simple. First of all, let me give you a quick overview. Cost of capital, a quick one. Cost of capital is basically what? It's the minimum rate, okay, is the minimum rate which the company needs to ensure that they cover for the shareholders, for the investors. Normally there are two groups of investors. One is shareholders and one is the debt providers. Okay, I'm talking about the bank. So it is very important for the company to ensure that company is providing or covering the minimum rate of return, minimum rate that is known as cost of capital. So cost of capital includes cost of equity. The cost of equity is basically the return that we need to give to the equity investors. It includes the cost of preference shares, the return that I need to give to the preference shareholders, and the cost of debt, the return I need to give to debt providers, which means normally it's the bank. Okay, so WACC or cost of capital includes all these three things. So whenever you are doing the calculation of WACC, you need to know how to work out KE. We normally call this as KE, KP, cost of preference shares, and KD is the cost of debt. Okay. Now for KE, a quick skim I'll give you in relation to what is being written here. For KE, there is the first method known as dividend valuation model. You can use these easy notes for your revision before the exam. I will not cover each and every point here, obviously. I'll just pick the important things. which are important for my question solving right now, but later on you can revise using these very easy notes here. So, dividend valuation model, DVM, is used for calculating cost of equity, that is known as KE. There are two possibilities. One is constant dividend and second is fixed growth in dividend, and you can see the formulas here as well through which we can work out these cost of equity. So, there are two approaches for that. Now, if I say fixed growth in dividend, so I'm assuming that the dividend will be, there will be an impact of growth in the dividend, and to work out the growth rates, we have two methods: past dividend pattern and earning retention model. Okay, we have past dividend patterns and we have earning retention models. So, this is all about dividend valuation model. The other model that is very much common for calculating cost of equity is known as CAPM, Capital Asset Pricing Model. Okay, and this is a very famous model for calculating cost of equity. So, the basic formula, as you can see here, it's RF plus RM minus RF into beta, through which we work out this. So, this model is basically very useful as well, and you can see here certain things are coming here. So, quickly I'll just give you the recap of important things here. So, according to CAPM, it provides you the return, number one, that is the risk-free return it provides you. Okay. Secondly, it provides you a return that is known as market return. Okay. And what is basically market return? The overall market return, okay, that the return that one can get from the stock market. So, it covers that as well. It covers the risk-free return as well. Okay. And itself, the formula is pretty much clear to all of you. So, basically, you need to remember that CAPM provides you two returns. One is the risk-free return, and this is basically for compensating the time value of money impact. Okay. And second return that it provides you, it's the equity risk premium return, that is for the additional risk that you take by investing in an organization. So, this is CAPM, known as Capital Asset Pricing Model. Now, CAPM obviously is a very good method because it considers the relationship between risk and return. So, it's practically much more useful when I say with DVM. So, it's much more useful compared to dividend valuation model. Okay. A quick one here. The beta that we use here in CAPM, what is beta? Beta is basically a measure of risk. Through beta, we measure the risk. So, remember key things. If beta of a company is more than 1, so it means that that particular company is a more risky company compared to the average stock market risk. And if it is a more risky company compared to the average risk of the market, which means that company qualifies for a higher return. The more the risk, the more the return. Any company that has a beta less than 1 is categorized as a company which has a lower risk compared to the average risk in the market, and if it is the case, so that company will qualify for a lower return compared to the market average return. Okay. Now comes a quick thing, I'm giving a quick recap here. So, beta, which risk beta covers? Is it the systematic risk or the unsystematic risk? So, you need to remember that this beta only gives you return for systematic risk, and it does not gives you the return for unsystematic risk. So, you as an investor, you as a shareholder cannot expect a company in which you are making the investment to give you return for unsystematic risk. So, you know why? You know why? Because unsystematic risk is a risk that relates to a specific industry or a firm, and this is the risk which you can diversify, you can eliminate by diversified portfolio. Okay, diversified portfolio. What is diversified portfolio? So it's a very simple thing. An investor should make investment in diversified portfolio to ensure all eggs are not in one basket, which it's very clear. As an investor, you can't invest all your money in one business. You need to spread the business. You need to spread your money in different areas. Invest in automobile, invest in a manufacturing sector, invest some amount in agriculture sector, invest some amount in service sector. So this is how you are spreading your investment, and this is how you are eliminating or reducing unsystematic risk. Okay. But the risk that the investor cannot avoid is systematic risk, which applies to the entire global economy. Okay, so you can't escape from this risk. It's impossible to reduce this risk. So because it's impossible to reduce this risk even through your well managed diversification, so you as an investor expect the company to provide you the return for the systematic risk, because investors cannot do anything about this systematic risk. They can't do anything. They can't reduce it by their own intelligence of diversification, as they cannot do anything for such kind of a risk. So they expect the company to give them the return for this risk, because they cannot reduce this risk through their diversified portfolio. So that is what I'm saying, that the beta that you use in Capm is a beta that gives you the return for systematic risk. The Capm model, the beta that is used, covers the systematic risk, because as an investor, you need this return. Why? Because you cannot diversify this risk on your own. Okay? So this is a very important thing for you people. I'm sure this is clear to all of you. Systematic risk return is given by Capm. Now, moving forward to the other areas. So after dealing with cost of equity, we also have cost of preference shares, as I mentioned earlier. So you should know how to work out cost of preference shares for the preference shareholders, and you should also know how to work out the cost of debt, and this is for the normally debt holders who give you the debt. So this is how you work out the cost of debt. Now there are different types of debts. I just need to bring in front of your knowledge. Bank loan is non-tradable. Okay, so the formula to work out this is very simple: interest rate into 1 minus tax rate, right? The other type of is irredeemable debt, which is a tradable one, which means you can trade irredeemable debt in the market. And when I say tradable, so it's clear that it will have a market value. It will have a market value. Okay, so this is the formula. Redeemable debt is also a tradable debt category. Again, it will have a market value. So for a redeemable debt, how do we work out KD is through IRR, and we'll cover up today through a question once I quickly move now. Then the next type of is convertible debt, a debt which is again a tradable one, a debt which also has a market value. So this is a debt in which it is expected that the debt will be converted into X number of shares at the maturity. So company gives bank an option, if they want to later on after 5 years or 7 years, convert the debt into equity and become the company's owner, the shareholders. This is convertible debt. So we also should know how to work out the KD of convertible debt, and for that again we basically use the IRR method to do the calculation, but there is a small change where we use the higher of value in the last year. Now, coming back to the important things, as I mentioned, bank loan is not tradable, so there will be no market value for bank loan. Okay, But all these three are tradable ones, so there will be market values, and the most common, the most examined one out of these is your redeemable debt. That comes a lot in your paper. Okay. So having said that, now let's move on towards the quick method how to work out WACC. Let's have a quick look. First, we estimate the cost of each source of capital, that is equity. We work out KE, we work out KP, we work out KD. Then we assign the weights to them. Now, weights normally are dependent upon two things. Either it's the market value, okay, weight, or it's the book value weights. The question states very clearly in the exam whether you have to use the market value or you have to use the book values, okay. But market value is obviously preferred because market value represents the current opportunity cost of finance. So once we have found out the weights, then we multiply the cost that we have worked out in step 1 with the weights that we have worked out in step 2, okay. And then we just add all, and we like this arrive at weighted average cost of capital, which is known as your WACC. Now, it was a quick overview I'm giving here. I'm sure my assumption here is because it's very near to the exam, people know the basics. Still, I'm giving you a good recap. If you know, you're able to recall and you will be able to manage this thing in a question. So now it's time to start with a question. It's time for section B. I think section B is becoming difficult these days as well because you can't relate things to the scenario. So we are basically starting with section B here. Remember, it's basically a 10-mark question, which means according to the allowed time, you have 18 minutes to complete this question. 18 minutes to complete this question. For that, what are we supposed to do? So remember, actively read the scenario based question, actively read the scenario, highlighting information that is relevant for each part of the requirement. Okay, so I think this is clear to all of you, and let's now begin with this part of the question and let's see how are we supposed to handle a section B type question that relates to WACC in the examination. So let's begin with the past paper question. Now we are starting with this question and this was tested in March-June hybrid attempt. So let's see what is being asked here. It's a section B type question, as you can see in front of your screen. So before you start the question, a quick word of advice is just figure out that what is the basic requirements. As you quickly skim through the requirements, you get to know that the areas that are tested. So once you then read the scenario, you can relate that to the scenario. Okay, so quick one. What to do? What is the cost of equity, KE, is what I need to work out, of Tulip Company using Capm. So yeah, it's Capm tested here to work out the KE. Second, using an estimate of 5% and 6%, what is cost of debt, that is KD, okay, KD of convertible loan notes. Wow, it's convertible loan notes, right? Then it's a theoretical question. It says, in relation to using dividend growth model, DGM, which of the following is to value Tulip Company? Which of the following statement is correct? Now, this basically is a question that belongs to the area of business valuation, okay? This question belongs to business valuation. I'll tell you why. Then you have which of the following statements about equity finance is correct? Another theoretical question. And regarding Tulip's company interest in Islamic finance, which of the following is or are correct? Okay, so very common these days, Islamic finance coming in the paper. So it is giving me a good idea the areas that are tested, like CAPM, like KD, like Islamic finance, like some part of business valuation as well is tested in this question. So let's now begin with this solution and let's see how to handle. Tulip is a large company with an equity beta of 1.05. The company plans to expand existing business by acquiring a new factory at a cost of 20 million. Okay. The finance for expansion will be raised from an issue of 3% loan notes issued at nominal value of 100 per loan note. Okay. These loan notes will be redeemable after 5 years at a nominal value or at convertible at the time into ordinary shares with a value expected to 115 per loan note. The risk-free rate is 12.5 and the equity risk premium is 7.8%. Company is seeking additional finance and is considering using Islamic finance and in particular would require a form which would be similar to equity financing. Now, scenario based is important. This is what is mentioned in the scenario. So you can't ignore this information at any cost. Okay. Let's begin with the first one. It says, what is the cost of equity? What is the cost of equity is what you need to work out. So let's see what cost of equity will be using Capm. So for that, I'll quickly jump to what I've done before. Okay, so I'll just go to the relevant area of Capm where I just saw about Capm stuff, and let's see what help I can take from this slide of mine. So I need to work out the answer or through Capm. Now, if you just have a good look, it says equity risk premium, right? So going back to the question, it says that equity risk premium. Now, is it the same thing? Yeah, equity risk premium. And here it is also equity risk premium. You can say it's the same thing. So when it's equity risk premium, remember it's RM minus RF, which means already this part of the formula is given to you. When you have equity risk premium, so it means it's RM minus RF, right? Market return minus risk-free return is given to you in that case. So for that, you need to keep this in your mind that I don't have to do anything else because it's very straightforward given to me here. So my calculation would be straightforward. I will look for the beta value here. I need equity beta, which is 1.05. I have the risk-free return here as well. So the calculation will be straightforward and will be 2.5 plus 7.8 into 1.05 the beta, and the answer that I'm getting here is 10.7%. So this is option B. The only thing that one can do wrong here is not treating this as equity risk premium and treating this as overall market return, which is a wrong thing. Okay, in that case, the possible mistake could have been that you would have used this RM minus, you would have deducted 2.5, and this was wrong in this case because it was equity risk premium, which means that already from the overall market return, the risk-free return has been deducted. Okay, so this is the quick method, simple, easy. I hope no problem in this one. Okay. Now, second is what? The second question you have here is about the next one, which is what? Let's see. The next that is given to me is using estimate of 5 and 6. Now, why they say 5 and 6. Why? They say 5 and 6 is because there are two discount rates that we normally use for the working of IRR for the purpose of KD, right? So that's why it says 5 or 6. What is the cost of debt of convertible loan notes? So now you have to ensure that you do use these two, because otherwise your answers might deviate in the paper, and to ensure it doesn't happen, you have to use this, right? Now, how will I perform this calculation of IRR? So let's begin with the solution. Let's see what to do. So you must know the working of IRR. So let's start with convertible debt. If I quickly jump to my presentation, so I will definitely move towards the convertible portion. Here is the convertible one. So it says that the steps involved are: assess both the options by calculating their value, cash option and conversion option. Choose the higher of value, okay, and calculate IRR. Okay. So let's begin with the workings. For IRR, what are we supposed to do? You need to keep in your mind the format, which is year, cash flow, the discount factor, present value, the other discount factor, the present value. Now, do keep this in your mind that discount factor first is 5 that you're going to take, okay, and second is 6 that you're going to take here, because it's simply mentioned here. You can't change. So the cash flows are what? So first of all, in year 0, we take the market value. So do we have market value given in the question? Yes, we do have. So what's the market value? The market value is 115. No. Okay. So, yeah. If you see here, it says the loan notes will be redeemable at 5 years time at nominal value or converted at that time into ordinary shares in Tuleco with an expected value to be 115 per loan note. Now, this is the basically the value that is given to you at that time after the 5 years conversion. So, what value will you take now? So, look at the wording. See, look at the wordings. A possible mistake was really possible to take this as your market value, which would have been wrong. Read the wording. It says the finance for the expansion will be raised. Now, this is a very important thing, which means the finance will be raised. You haven't raised the finance yet. You haven't raised the finance yet. You will raise the finance from an issue of 3% of loan notes. Now, by understanding this, it's very clear that finance hasn't been raised yet, and you will raise. And if you raise through what you say, the convertible debt, so now what will be the market value? So you should know this. If you haven't raised the bond or convertible bond yet, and will you raise it in the future? So in that case, it is important to look the amount on which it will be issued. So it says it will be issued at nominal value of 100 per loan note. Now this is the market value. So the possible mistake that people can do in the paper in a question like this is they simply take 115 as market value, which is wrong. The market value is 100 per loan note in this case, because the bond hasn't been issued yet and it will be issued at its nominal value. So this is the value that one should take in year 0 right now. So once you issue it, you will issue this at nominal value. So I'll take 100 as my value for year 0. Now coming towards interest. Okay, So what is the coupon rate? The coupon rate that is given to us in the question is basically simple, 3. Okay, the coupon rate is 3. Now, do we have any taxation given here, any tax rates? No, if we don't have, so we'll not make this after tax. Otherwise, we should make this after tax. Okay, but right now we will not make this after tax because it's 3% and you can't see any taxation rate given here. So directly we'll take this 3% because it's per bond. Our entire working will be per bond. This is market value per bond, interest per bond. Okay, so it's simple, 3% into the nominal value. You need to remember, if you're not sure, always coupon rate we apply on the nominal value of the bond. Okay, so we always apply nominal value. So 3% into 100 makes 3, and how many years? So it will be either converted or redeemed in how many years? So it says 5 years, right? 5 years. So I'll write here 1-5. Okay. Now the amount, redemption amount or the conversion amount. So in the last year, normally what we take in case of convertible the higher of value. So if you look back here, you take the higher of value. This is the higher of value you need to compute. Higher of between two options, the cash option, okay, and the conversion option. Because as a bond holder, if you are the bank, so what you will want to do? You want to see how much benefit this will give you. So what you will do, you would want to see whether this will be more beneficial when you convert it and whether it will be beneficial if you redeem it. Okay, so as a bond holder, as a bank, you will look at the higher of value. So let's see what options do we have for the higher of. Now if I say higher of in the last year, so I will compare two options. One is the cash option, normally known as the redemption option, and one is the conversion option. Okay, so if I say conversion, okay, if I say conversion, so in that case, what will the value that I'll get here? So it says either you will redeem at nominal value, okay, or it will be convertible at that time into certain number of ordinary shares with a value expected to be 115 per loan note. Per loan note. Entire working is per loan note. So I don't have to work out the value of the shares because it's already given to me. So it's a comparison between 100 cash option and 115 the conversion option. So it's a good thing I don't have to do myself. Normally in questions you do work out the future value by using the share price and just growing the share price into X number of years. Okay, so it's simple. The higher of value is 115 that I will be taking here. I'm sure you don't have any problem in this case as well. So it's 115 that I will take here. It's the higher of value, so 115 I will be taking here. Now the comparison done. This is what I'll select. Let's begin with the working. So here 0, it's 1. Using 5% discount rate, I'll use the annuity factor for 5 years. So what is the annuity factor? 4.329 and single discount factor is 0.784. So after this, let's work out the present value. Once you multiply these, you will get the present value. So it's 100 negative. Okay. Second, it's 12.99. Third, it's 90.16. And you work out. So you will get a positive NPV of 3.45. So for IRR, the ideal is to get one positive NPV and the second negative NPV. So using 5% is positive. Now let's work out using 6%. So this remains same 1. The annuity factor for 6% using 5 years will be 4.212 and single discount factor is 0.747. So this is 100 negative 12.64 and 85.91. Okay. So if you work out this, so you will get a negative NPV of 1.45. So ideally, it's good to have one positive and one negative, and this is the case right now. I hope this is clear to all of you, and obviously there's no issue here. Now it's 1.45. So what to do? It's simple, my friends. I'll use the formula of IRR now to work out the final answer. So let's input everything into the formula of IRR. Okay. So IRR formula, the lower rate is 5 plus, open the bracket, NPV at this lower rate is 3.45. Divide by NPV lower rate 3.45. By default the sign is of negative. Now NPV of higher rate is 1.45. Right? Higher rate is 6 minus lower rate of 5, and you can work out using your calculators. So the answer is 5.7, because it's a very close answer of 5.2 here as well. So it should be very much perfect in terms of calculation. So it's 5.7% as your answer of convertible debt IRR, which is the KD of convertible loan notes. Okay. So I hope this is clear to all of you. For section B's, a quick advice I need to give you people is that, remember, certain questions will take less time, whereas the others will take more time. So this is how the question has been structured by the examiner. Certain questions will take less time, certain will take more time, and this is what you need to keep in your mind, that 18 minutes is the max you have to spend on section B question, max. You can't do this for section B, that you try to complete one question in 3.6 minutes, okay? Because certain questions in section B will take more, the others will take less. So average out is what you need to do. So the criteria is 18 minutes you need to spend maximum to find out the entire answer for the section B. So I hope this is clear to all of you and there is no issue at all. Okay. Now, in relation to using DVM to value, now you should know that dividend valuation model is basically a one that is used for both. That is used for both calculating KE and also for the valuation of share price as well. Okay, so it has a multi-purpose use when I say that you can use this for two things. So now if I just go back to the slide of DVM. Just wait, please. Okay, so you can see here that DVM is something that you can use to work out KE, as well as DVM can be used for calculating the share price. Now, I'll quickly jump towards the next area for today as well, and that is business valuation. So, if I quickly jump towards business valuation as well, so I will show you there that business valuation is an area where again you see dividend growth model coming up. And the reason is that this dividend growth model is a one that you can use for calculating KE as well as for calculating the share price. you just reverse the formula. Okay, you just reverse the formula. So you should keep in your mind, whenever the question says work out the value. So do remember, it's a business valuation question, and DVM is now used for calculating the share price. This is P naught. P naught is basically share price. Okay. But whenever you are required to work out cost of equity, so you quickly will figure out that it's the DVM formula that is being used to work out cost of equity, and this is the formula you have to use, that is for KE. So it's simply a rearrangement of the formula. Okay, in WACC you work out KE because you already have share price available, which is P naught. Okay, but in business valuation it's the reversal that you do, and that is when you come towards that, it is the KE that is given to you and you work out the share price. Anyways, so let's look here the purpose for which it is being used. So it says value. Okay, so when it says value, it's clear that it's basically a question related to business valuation, right? So it says in relation to using DVM, which of the following statement is correct? So let's read the statements. Number 1, the model assumes that all shareholders of Tulip Company have the same required return of rate of return first. Second, the model assumes a constant share price and a constant dividend growth for the company. Third, the model assumes that capital markets are semi-strong, form efficient. The fourth is the model assumes that Tulip Company's interim dividend is equal to the final dividend. Okay. Now, out of all, the correct assumption, the correct statement I would say is statement A. Okay, statement A is the most correct one, because this model assumes that all shareholders have the same required rate of return. Okay, because according to this approach, dividend is the only way of giving income to the shareholder. So you can quickly look at the assumption. As you can see, according to the assumptions of DVM, the shareholders' future income stream is only through dividends. Okay, it's only through dividends. Okay, so it's only through dividends, which means that the assumption is very much clear that the same required return will be given to the shareholders. So this is the assumption that the dividend is the only income stream, and it is very much defined that the return that they will get will be the same required rate of return. So this is basically the right assumption that you will select here as the best one in this case. Okay. So this is the dividend growth model assumption that you have to follow here. I hope this is clear to all of you. In this case, the answer is A for question number 18. Okay. As for the other, these are not correct, because the second one says constant share price or constant dividend growth, which is a difficult assumption again. Share price may change, the growth rate may change. So this is not the right statement in this case. Okay. So I hope this is clear. Now moving towards question number 19, let's see what it says. Which of the following statement about equity finance is correct? Equity finance. So let's read. Number 1, equity finance reserves represents cash which is available to a company to invest. Is this a true statement? No, it's not. Equity finance reserves represent cash. That is not true. It is not just cash. It's not compulsory that it is cash based. Okay. So equity finance reserves includes something which is not cash as well. Okay. Second, additional equity finance can be raised by right issue and bonus issue. So can you actually raise equity finance through bonus issue? I don't think so. Do you think? You can't, because bonus issue is not helping you to raise further finance directly. Okay, right issue gives you cash, but not bonus issue. Third, retained earnings are a source of equity finance. This seems to be correct, but let me read the fourth one. Equity finance includes both ordinary shares and preference shares, which is completely wrong, because equity finance includes preference shares only. So this is the right statement. Now in MCQs, my suggestion is that there is one distractor, or there are different distractors given. So try to find out the distractors. One statement is the one that comes closest to your concept is the answer. So there are distractors that will distract your mindset, and you need to just remove those distractors so that you are able to figure out the correct answer. So this is the one. The best one is C. I hope this is clear. The last relates to Islamic finance. So let's not leave this as well, and let's solve this before I move towards the next area. Regarding Tulip Company's interest in Islamic finance, which of the following is or are correct? Okay. So let's have a look here. What it says, friends. Murabaha could be used to meet Tulip's financing needs. Mudarba involves an investing partner and a managing or a working partner. Now what I need to do? I need to go to the scenario. Let's not be generalized and see what it says. Just highlight this. See, the company is seeking additional finance and is considering using Islamic finance, and in particular would require a form which would be similar to equity finance. Form which would be similar to equity financing. Equity financing. Let's go back now and let's see which form is similar to equity financing. Okay. Murabaha could be used to meet the company's financing needs. Now listen, this is the problem my students are doing in the paper, and this is what your examiner is mentioning a lot, that in section B, people are not relating things to the scenario. That is why my tips did mention that you need to link with the scenario. So listen, first of all, question like these, especially of section B theory I am talking about. Two things you can do to solve this very easily. First, just ask yourself the first question, that in general terms, is this true? This is the first question you need to ask. Secondly, according to scenario, according to case, is it true? Sometimes you will feel and see that in general terms something is true, and you will say, okay, this is right. But according to scenario, it will not be true. This is a problem that people are doing. Try to understand what I'm saying here. In general terms, this might be true, but not according to scenario. So that's why ask two questions from yourself. Let's apply this technique. Murabaha could be used to meet the company's financing needs. Now, in general terms, it's yes. It's yes. But according to case, it's a big no. Why? Why? Just look. Look in the scenario. It says we need similar to equity financing. So, Murabaha is not similar to equity financing, because in Murabaha, it's a trade agreement. If you know the meaning of Murabaha, it's a trade agreement where Islamic bank buys a product on your behalf and then sells that to you for a later payment on credit. So Murabaha is basically a trade credit type of a thing. It's a trade credit type of a thing. Getting the point? Murabaha is a trade credit type of thing. It's not similar to equity finance. So in terms of general, yeah, it will fulfill their needs of financing. But is it relevant keeping in mind the scenario? No, because it's a type of a trade credit, not similar to equity finance. Understood, guys? Are you learning this new approach? Yes or no? This is the flaw people do in the exam. Come on, what's your feedback? Is it clear to all of you? Say yes or no. This should be clear. The way I'm explaining, the way I'm telling you how to link, this is the flaw that students are doing in the paper. In general terms, that's perfectly right. But in terms of scenario, that's wrong, because murabaha is not similar to equity finance. Understood? Second one, mudarba involves an investing partner and a managing or a working partner. So mudarba is what? Yeah, mudarba is a partnership type of an agreement where there is one investing partner. Now, investing partner and other is the working partner. Mudarba, right? So this is similar to equity financing. This is similar to equity finance. Yes, because this is a partnership type of an agreement and this is similar to equity financing. So yes, I would say that very much simple in this case is that mudarba is basically similar to equity financing, and the correct answer is B. So in general terms, yes. In terms of scenario, yes. Two questions asked. In general terms, yes. In terms of scenario, yes. Why in terms of scenario, yes? Because they need similar to equity financing, and it's a partnership agreement where one person is injecting equity and the other is working there as a working partner. One is a sleeping partner, one is a working partner. So Islamic Bank is a sleeping partner and you are a working partner. So yes, it's similar to equity finance. So I hope you will understand my technique of asking yourself, in general term, is it true? Yes, it is. In terms of specific, is it true? According to scenario? No. For that, if you read the scenario and you understand each and everything that is written here, so you will not do wrong, and this is the flaw examiner is mentioning in the paper, that people are doing such kind of mistake. They are not relating to the scenario. They are thinking in general terms. They are treating this like an isolated question, which is wrong. So I hope small effort that I am putting here will benefit you a lot in the examination. Okay? So guys, what's your feedback? Learning new things? Yeah. Bisma Khan, we need to select the answer according to scenario, not in general terms. Yes, this is what my point is. Yes. Understood, guys? Okay, great. Now, it's time to move towards business valuation. Now, a quick idea, those who are new here, WACC, okay, and business valuation. WACC is opposite to valuation, and it's a $1 million observation, I'm telling you. You can check whenever you want. In WACC, your mindset is of a company. So you work out the cost because company takes finance from equity investors, from debt people. So company needs to cover up the cost. Okay. So for company, it's a cost in WACC. In business valuation, your mindset is not of a company, but your mindset now is of an investor. In WACC, your mindset is of a company because you're working out cost of equity, cost of debt. So there the focus is all towards cost. But here, your mindset is of an investor. An investor is the one who is providing the finance. So investor could be equity investor. It could be a bank. Investor is investor. The one who is providing you debt is also an investor. The one who is providing you equity is also an investor. So in business valuation, we are concerned about calculating the values, not the cost. Value of equity, okay, which is your share price actually. Value of debt for the bank. Value of redeemable debt. Market value of convertible debt. Market value of irredeemable debt. So, in business valuation, you are concerned about calculating the values. Whereas in WACC, you are concerned about calculating the cost. Just observe, you will find the same observation. So, in short, in WACC, you work out KE, KP, KD, right? In business valuation, you work out value, share price of equity, share price of preference shares, and the market value of debts. Because the perspective is different. So, it's the opposite I always tell my students. Whenever I teach in my sessions, online regular students know the fact that it's the opposite way around. I create a link between these two. So that makes it really easy for people to understand. And in the paper, you are easily able to figure out which question relates to WACC because cost is being asked and which question relates to valuation because value is being asked. So simple to cut the long story short. If the question requires you to work out cost of any kind, it's WACC. And if the question requires you to work out the value of any kind, equity, preference or debt, it's the business valuation. I hope you love this difference. The last thing, remember, in WACC questions, you need to work out the cost and the values may be share price or market value in case of debt, share price in case of equity, whereas market value in case of debt will be given to you. So, this will be given to you and you need to work out cost. Getting the point? Quick, important revision. Whereas, in case of business valuation questions, remember my words, remember my golden words. Values like share price, market values is something you need to calculate, whereas the cost like KE, KP, KD will be given to you. Will be given to you. Understood, everyone? So, the cost will be given, you need to work out value. So, it's a quick idea I just gave you, difference between WACC and valuation. Let's begin now. There are different techniques to work out the value of share price. If I start with equity, so for equity, we have first technique of discounted cash flows, very much similar to the workings of NPV. We work out the present value of future cash flows. That is the value of the company. The other method similar to what we did in WACC is DVM, again used here, but this time you are working DVM. You are using DVM to work out the value of the company. And again, there are two things here, constant dividend mindset or the fixed growth in dividend. So you can see the rearrangement of the formula. The formula has been rearranged here. Okay, compared to the method that I just told you right now, the one was DVM used for KE. Okay? So do keep this in your mind. This is DGM used in valuation and that was DVM used in WACC. The difference is, in that case, you were required to work out KE, value of share price was given, and here you need to work out share price, whereas KE will be given. Then the second group is asset-based valuation, in which you have three methods: book value, net realizable, replacement. I think it's time to move towards past papers, and let's use the questions and then come back to the areas here. The third group of valuation is earning-based valuation techniques, income-based valuation techniques. So there are three groups. This is the income-based, this is asset-based, and this is cash flow-based. So there are three groups, and this is how I teach every time. So cash flow-based has two techniques: DCF, DGM. Asset-based has three methods: book value, NRV, replacement. And income-based has three methods: PE ratio method, earning yield method, and dividend yield. Let's not waste our time. Let's begin with another question of section B. Remember to complete this in 18 minutes. Now, remember, business valuation will be tested in either section A of your paper or section B of your paper. It will come either in section A of your paper or section B of your paper. This is for sure. It will not be tested in section C, so there is a very, very high chance, as I mentioned yesterday, that valuation will be tested in section B and a tough question may come. So learn the technique, actively read the scenario, highlight information that you are able to relate it. Let's not waste our time and let's move towards another question that relates to business valuation. It's time to move towards this very important one. So you can see here, let's start reading. But before that, I tell you that let's quickly look at the requirements. What is the value? See, value, business valuation. Value is a business valuation based on net realizable value basis. Second, what is the value using earning yield method? Okay. When valuing using asset base, which of the following statements is correct? Which of the following is or are indicators of market imperfections? Which of the following is correct? Okay. So now, let's begin with the question. Extract from the financial statements of Bluebell Company, a listed company, are as follows. It's very important to highlight in a business valuation question whether the company given is a listed one or not. Okay. So, Bluebell is a listed company. So, this is pretty much clear. You have PBIT, finance cost, profit before tax, corporation tax, and profit after tax. You are given with assets, which includes goodwill, internally generated. You have current assets. You are given with the value of long-term and short-term assets. So, this is your total. Okay. Now, let's see. It says a similar size competitor company. Okay. A similar size competitor company has a P ratio of 12.5 times. This competitor believes that if Bluebell were liquidated. Now, this is a very important condition, were liquidated. This is giving you a hint here. Property, plant and equipment would only realize 600 million, while 10% of trade receivables would be irrecoverable and inventory would be sold at 30 million less than its book value. Liquidated. Okay. Separately, Bluebell is considering acquisition of Deco, Now, Bluebell is considering acquisition of TECO, an unlisted company, which is a supplier of Bluebell company. It's an unlisted company. Okay. Now, what is the value of Bluebell on a net realizable value basis? So, what hint you got from here? Listen, NRV of net assets is what you need to work out. Remember, always you use net assets for asset-based valuation. So, if I go back here and if I just try to go to asset-based valuation, so remember, out of these three, the most useful is NRV method. And in this NRV, our assumption is of liquidation basis. What is liquidation? Which means if the company finishes off today, it is liquidated today. So, what will be the value, the net realizable value of the company's asset if it is liquidated today? And I am talking about the tangible assets, okay? Tangible assets. Getting the point? So, see how I'll help you to solve this. Now, the best is NRV. And always we work out the net assets. You know how to work out net assets? The formula is what? It's all assets minus all liabilities. Okay? The formula of net assets is all assets minus all liabilities. So, book value is not good because it's historical. Book value net assets historical. Replacement costs, again, it's not useful. Okay? So, the best is NRV of some used asset or a company. Right? So, let's now work out. First of all, let's do a quick working. Let's first work out the book value right now of net assets. So, as I mentioned, the formula is all asset minus all liabilities. Okay. So, assets 673 book value. Now, what about this one? Should I take this or not? This is a big question here. Should I take this or not? So, I'll take help of my notes here. The disadvantages of asset-based valuation, point number 2 says, method ignores non-balance sheet items, intangibles such as goodwill, brand image, know-how, strong management team. So, because it is based on tangible assets, it's a drawback that it doesn't consider intangibles, which means you do not have to take intangible of 105 here, which means you will not consider this 105 right now. Understood? This method ignores intangibles. Okay? So, it's clear that I will remove this intangible because of this method drawback mentioned here, and the figure that I'm going to take is 768 as my non-current asset. I'll add 477 of current asset. So, that makes how much? 1245. Okay. Now, from this 1245, I will deduct the current liability of 662 and like this I will get a value of 623, which is the book value of net assets. As I told you, net asset is what? All asset minus all liability, right? So, I did mention here why I removed this, because this will not come, this is not a tangible asset. I just took the value of non-current asset, current asset, total asset, deducted total liability, and this is my net asset book value. Okay? So, the book value net asset is 623, as I just showed you the workings above. Now, to convert this into NRV, I need to make certain adjustments. So let's see the adjustments. Property, plant and equipment would only realize 600 million. Okay. So how much it is right now in the balance sheet? It's 768. 768. So how much will it realize? 600. So by how much amount I need to reduce this? Less reduction in value. So what to do? 768 minus 600, which means by 168 the value of your net assets will go down because you will not realize at the time of liquidation. Okay. Then it says 10% trade receivables would be irrecoverable if in case of liquidation. So where is your receivable? 192. So 10% will not be recoverable, okay, of 192. So again, let's deduct the impact of bad debts. It's 19.2 you need to deduct because this will not be recoverable for you. Okay, got it? Then it says the inventory would be sold at 30 million less than its book value. 30 million. It's not that the value will be 30 million. It says the value will reduce by 30 million. By. It's by. Okay. So let's make an adjustment of inventory 30 million. Got it? Now, I started with the book value of net assets. I removed goodwill because disadvantage is mentioned that goodwill will not come here. I'll reduce the value by this 168 that I will not realize on property, plant and equipment, bad debts and reduction in inventory. If I deduct all these, let me see where I will be standing at. Okay, so it's 623, 168 is the adjustment I'm going to make here, right? And 19.2, okay, minus 30. So if you work out, now what adjustments we have made already here? So let me tell you that we started with this 768, okay. We'll add 477, right? It's 1245. I will deduct 662 from this. It's 583. A small mistake I did here. It's 583. I just wrote it wrong. Yeah. You can just change your answers, please. It's 583. It was a mathematical error. So 1245 minus 662. It's 583. Okay, 583, and I'll just take this figure of 583 here because my answer was not coming here, so this was a small mistake. It was just a calculative issue. Yeah, 588. Okay, so it's 588 as you can see. Book value of net assets. Now 583 is the 583. So 583 minus 168 minus 19.2 minus 30 will give you 365.8 as NRV of net assets. Okay, I hope this is clear to all of you. There could be different methods to come at the same answer. That is all equally possible in the paper. Not a requirement to show the working like this because it's section B. But I hope the basic point is clear. What was important, the possible mistake people can do is they consider this goodwill as part of the asset, which was wrong here, which you do not have to consider. The rest was a simple NRV based question. So this could be one of the mistakes that anyone can do. Anyways, I hope this is clear to all of you. Now, a very simple thing I need to tell, that those who will not ignore this 105, so see their option in the paper, if you take 105, your option in the paper will be 470.8, okay? And you would have easily said that this is the answer, which is not the case. You will lose the marks because this method doesn't consider internally generated goodwill. Hope this is clear, okay? True? I hope this is clear to all of you. Now, let's move towards question 22. Simple. What is the value of Bluebell using earning yield method? Okay. So, if I just move towards earning yield method, so this is the one which is part of income based valuation. For that, normally we need earning yield. So, there are two methods. One is with growth and one is without growth. So, remember, if the growth rate is given to you in the paper, then you have to use with growth. Otherwise, it's without growth. So, the formula is EPS divided by earning yield, right? Now, in this case, it's a different way of finding out the answer, because in this question, you will not find earning yield mentioned here. You will not see earning yield, because if you want to work out using earning yield, so what is important is to work out the value, you need two things, right? You need earnings, okay, divided by earning yield. So, you don't have earning yield here. You have earnings here, and the earnings are given here. Profit after tax is your earning. Okay, this is your earnings. Are you getting the point, everyone? So, this is earnings. That's fine. But what we don't have, we don't have earning yield. We have this 150, but we don't have earning yield. So, what to do? So, very simple. Remember, a simple method, a simple way I'm telling you, just keep this in your mind. If you don't have earning yield, you can work out through PE ratio divided by this method, 1 divided by PE ratio. Okay. So, it's a very quick shortcut, will give you the answer. Remember this. If you are not given with earning yield, remember this quick shortcut to find out earning yield. That is 1 divided by PE ratio. You are given with PE ratio. Yes, you are. So, you can use the similar size competitor company PE ratio. Okay. And through this, you will find out the answer. So, earning yield is equals to 1 divided by 12.5. Okay, so what is the answer? 1 divided by 12.5. Remember this formula, okay? So, the answer is 8%. How much? 8%. Yeah, it's the reciprocal, right? Yeah, it's the reciprocal. You're right. So the formula is quite simple. It's the reciprocal of P ratio. So that keeping that in mind, it's simple. Earning yield is equal to 1 divided by P ratio. You don't have earning yield. You can work out earning yield like this, and now you can find out the answer. So just use this 0.08% here, sorry, 0.08 here. So 150 divided by 0.08 will give you 1875. Agreed, everyone? Say yes or no. Are you with me? Is the session getting useful? We are doing questions, we are doing practice. What's your feedback? Useful or not? Learning new things. Yesterday our focus was on spreadsheet. Today our focus is on section B question. Is it helping you people? Come on, give your feedback in the comment section. To the point, summarized, revision with practice. What else can you expect? Okay? Right. So done with this one. Now, the 3 theoretical OTs. Basically, people are struggling in theory-based OTs. This is my observation. For that, you need to have a good grip over theory. Okay? So what it says, when using Bluebell company, when valuing Bluebell company using asset-based valuation, which of the following statement is correct? Okay? Now, statement 1. Asset-based valuation would be useful for an asset stripping acquisition. Here I'll stop and will go to my notes and will take help of my notes. Usefulness of asset-based valuation. Wow. Asset-based valuation is useful in asset stripping situation. Now, this is the knowledge you should have in your mind. What is asset stripping situation? A situation, a process of selling the individual assets of the company rather than the entire company. Yes, sometimes there is a possibility that selling the entire company will be not that much advantageous for you. Maybe you have a bad location. One quick example, you own a petrol pump, the refueling stations. And that petrol pump is in a bad location where lots of cases of robbery are existent. There are thieves near the petrol pump. So it's a bad location. Nobody prefers going there for the refueling because they know that 70%, will be affected or they will become victims of the robbers. So it's a bad location of the pump. Now you need to sell that pump. You need to sell that pump. So you just gave an advertisement in the newspaper. Hello, anyone who wants to buy this? People say, no, very bad location. We don't want to buy your petrol pump. So you can't sell the entire pump now. So what's better? You sell through asset stripping, which means you sell the different refueling machines separately. So you started selling machines separately, other equipment separately, and this is more advantageous for you to sell separately rather than to sell the entire company, because nobody is willing to buy the entire company. When you sell equipment separately, so you will realize more amount. You will realize more amount, and this is asset stripping, which means the process of selling individual assets separately rather than the entire company. So here asset base works well because you will work out the separate NRV of one machine, second tangible machine, third tangible machine, and like this you will sell in the market. Understood? Asset stripping. So yes, it's useful in case of asset stripping, the first one. seems to be the correct one, and this is the answer. Let's read the others. Bluebell workforce can be valued as an intangible assets, so you know it doesn't consider intangibles. Third, asset-based valuation consider present values. It doesn't consider any present value, so that's wrong. It just considers the tangible asset value. Replacement cost basis provides a deprival value. It's wrong. Replacement cost basis provides you what it will cost to buy a similar new asset. So replacement cost gives you the value of a similar new asset value, not the deprival value. So that's wrong. Okay. So 1, this is correct. Understood, guys? I'm giving you the concepts, revising the things, and in the same way we are solving a question. I think a very good approach considering we are very near to exam. 24. Which of the following is or are indicators of market imperfections? You know what market perfection is? A perfect market is a market where everybody, shareholders exactly know what the directors are doing. Every decision of director is clearly in the minds of the shareholder. Directors are informing shareholder about every move they take. Perfect market is a situation where entire information is available to the shareholders. So let's see what is market imperfection. It's the opposite of perfect market. Low volume of trading in shares of a smaller company. Okay, the first one, right? Overreaction to unexpected news. Now, this seems to be correct. First, reason is very simple, because people are not aware of the director's action, right? And if people are not aware of the director's action, which means if something unexpected happens, they react. Okay, because they are not completely aware. And because of this, I can say that people are not interested in trading in the shares of smaller company because they are not certain what will happen in a smaller company. Because of imperfect market, they exactly don't know what the smaller company directors are doing actually, and they don't want to take such a big risk by making investment in small companies. So that is why low volume of trading happens in case of small companies. So that is perfectly true. Because of imperfect information, people are always scared and they are not willing to take risk in small companies. So both the statements are correct. See, this is how you need to handle it. Okay? The last for today, which of the following statement is correct? Okay, so let's see which is correct. DECO. What about DECO was mentioned here? Bluebell is considering acquisition DECO, an unlisted company, okay, which is supply of Bluebell's Co. Now, DECO is easier to value than Bluebell because a small number of shareholders own all the share. No, it's wrong. Actually, DECO is an unlisted company. An unlisted company is difficult to value because you don't have complete information, you don't have stock, listed share price. So unlisted companies are difficult to value because you don't have stock, listed share price for them. For a listed company, valuation is easier because of stock exchange prices are available. It's a listed company. That's wrong. Second, Bluebell will have to pay a higher price per share to take control of DECO, okay, than if it were buying a minority holding. Okay, in terms of general, I would say that seems to be correct. If you are buying a majority shareholding, you have to pay more because minority shareholders of a target company are entitled to dividends only. So they are not very much concerned because minority shareholders don't have the voting right. And if they don't have the voting right, so they can't charge a premium for that. If you buy a share holding from a minority shareholder, the only thing you get against that is the dividends that the company will give you. You will not get the right of voting. So to get the right of voting of any company, you need to pay more kind of a premium to get the majority shareholdings voting. So in general terms, it seems okay. But still, I need to look at the other options to see whether this is the correct one or not. This is how you approach MCQs in section B. Scrip dividends decrease liquidity of shares by retaining cash in a company. Scrip dividends actually decreases liquidity. That's totally wrong, because scrip dividend is an option in which the company offers share as dividend, not cash as dividend. And in that case, your liquidity never decreases, rather than it increases. Because in scrip dividend, you are paying shares as dividend, not cash as dividend. So if you're not paying cash as dividend, your liquidity increases, not decreases. So that's totally wrong. Okay, this is how we select and come to the closest, the best option. DCO share will trade at premium to similar listed shares because it will have a lower cost of equity. Totally wrong, because it is an unlisted company. So how can its share be traded at a premium compared to a listed company? Compared to a listed company, unlisted company never gets a premium. See, listed company are listed, so less riskier, more safer company. People have confidence in a listed company because they know its share price is genuine one, valid one. You can rely on the share price. But for an unlisted company, shareholder is taking more risk. Reason is that they are not confident about the company's share price because it's an unlisted, more riskier. It's difficult to sell the shares of that company. So how can you get a premium? That's totally wrong, and this statement is the best and the correct one in the current situation as well, in general situation as well. So it is the best one, and this is the right answer. I hope the methodology, the way to approach OT section B questions are clear, very clear to you people, and you now know the basics of spreadsheets, narrative questions of section C, and how to approach section B OTs. I hope this is all clear to all of you. So this is what all we were required to do today, and this is what we did. Thank you very much. Now quickly, your questions and your feedback, very important. I hope my quick easy notes will make things really easy for you. Quick easy notes, right? So guys, happy with today's session? The coverage in the current time span, the way I am explaining you, giving you the recap, revision, practice, techniques. Happy or not? You like the way? Okay, I hope you all are happy. Now for the mock package, it will be held soon. After the tomorrow's session, I'll announce the date of mock. Those who are interested in getting this mock, you can just contact me. I'll share the things. If you're not part of the group, make sure you send me a quick WhatsApp message. I'll send you the link, and in that group, I will share the easy notes plus the details for the mock package as well, and the details for the free grand revision. Don't miss that. Thank you very much. Be part of tomorrow's session. It will also be a very interesting one. Until then, take care.